Well, good afternoon, everyone, and good morning to those of us on the West Coast. Welcome from SABU, the Society of Business Journalists. Today, as part of our ongoing training efforts, we present a webinar featuring just released data from the Philadelphia Federal Reserve on how Americans have coped financially during the pandemic. I'm Marty Steffens, SABU Chair, a business and economic professor at the University of Missouri. Along with SABU, we want to thank our partners, the American Statistical Association, for sponsoring today's webinar. The ASA is a nonprofit promoting the practice and profession of statistics. This new data, gathered by talking with a scientific cross-section of Americans, will give us a glimpse into how segments of society were affected differently by the extended COVID period. This new data gives us an idea as to why the US economy might look different as we move forward in this post-pandemic recovery. Our panelists today are Tom Akana, advisor and research fellow at the Consumer Finance Institute of the Federal Reserve Bank of Philadelphia. And he'll share results of this latest portion of his ongoing study, which was just released yesterday. Our moderator today will be Pia Sarkar, a business news editor at the Associated Press in New York. If you have questions for our panelists, please add them to that chat function at the bottom of our webinar. Those questions will be seen by our panelists, and Pia will moderate those questions. And now our presentation. Welcome, Tom.
Okay, thank you very much, Marty, and welcome to everyone. It's a pleasure to be here presenting on this work. It's a project that I've been involved with and working on here at the Philadelphia Fed for over a year now, since the pandemic began. It's producing some really exciting and interesting information, so I'm very happy to share it with everyone. I'll go ahead and just jump right into it. Go ahead and get my screen up and running. Okay, as anyone who has ever seen someone from the Federal Reserve or any of our sibling agencies present knows, I do have to get a quick disclosure out to everyone. So the views expressed in this presentation are solely those of myself and do not necessarily reflect the views of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. Nothing in the text should be construed as an endorsement of any organization or its products and services. Any errors or omissions are the responsibility of me, and no statements here should be treated as legal advice. So with that out of the way, I'll touch on what we're going to be talking about today. First, I'm going to spend a few minutes really just describing what the Consumer Finance Institute is, what we do at the Philly Fed, and then how we approach the survey. Second, I'm going to cover the meat of the presentation and go over some of the key results from the most recently completed wave of the survey. And lastly, I'll wrap up with a brief discussion of the role of surveys and data at the Philly Fed and within the larger Federal Reserve System. I'll also have my contact information, as well as some additional resources for anyone who's interested. As Marty mentioned, you can put questions into the chat window, and we'll do our best to address them during the course of the presentation or at the end during the conversation with Pia. So what is the Consumer Finance Institute? We're part of the research department at the Federal Reserve Bank of Philadelphia that focuses on research into the ways consumers in the economy interact with each other, primarily in the realm of the payment systems and the ways that consumers pay for things, spend their money, save, and invest. Our main goal, as with the research departments in the other banks around the system, is to generate work that informs policymakers inside and outside of the Fed, ultimately to help establish a healthy consumer sector and contribute to a stable and robust economy. Within CFI, as I said, we focus largely on payment systems, consumer debt, and related topics. But we also have specialists who focus on things like education finance, health insurance, mortgage markets, and elder financial abuse, among a variety of other topics. Now I'll talk a little bit about the survey that we're discussing today. Obviously, when the pandemic hit at the beginning of 2020, it really became imperative within the Fed, and frankly, pretty much everywhere else, to try to begin understanding what the impact on the economy and on consumers was going to be. The Fed system has a ton of existing data available, for analysis of economic trends and outcomes. But as extensive as those data sources are, they come with some limitations. The first one is timing. The data available to the Fed, and frankly to most other public sector institutions, often comes with a delay, both in the timing of the data, do you get it monthly, quarterly, biannually, and in the delivery of the data. Generally, by the time it becomes available to the analysts, you're often dealing with snapshots of information that may be a few months old. In normal times, this isn't that big a deal, but given how fast things were changing last year, it meant that we would potentially be using information that was already out of date. Now, people around the system began working immediately to try to improve that and make sure we were getting more timely information, but it was definitely a challenge right at the beginning. The second is flexibility. A lot of the data that we get, including that we collect from existing surveys, is already well established in terms of its format, its content, the frequency it's delivered, et cetera. As I said, work began very quickly on updating some of those existing processes to get new information specifically related to the pandemic, but that's a big challenge. Everyone has always heard the analogy of trying to steer a battleship. This was like trying to steer an aircraft carrier in some cases. The last one is specificity. A lot of the data that we use for economic analysis is aggregated in some form or another. That's great for getting big picture looks at what's happening nationally or in a region or within a certain group, but it makes it challenging to drill down to see some of the underlying reasons for the trends. For example, one of the bigger trends that got identified during the course of the pandemic is that credit card balances in general have been decreasing. That's an important change in the trend that those balances have been following up until 2020. But at the aggregate level, it's challenging to get any insights into why that's happening. That's where survey data can help. So here at the Philly Fed and in CFI, we saw an opportunity to take some of the experience that we gained doing a survey on contactless payments in 2019, and we quickly launched a COVID-related survey in an attempt to try to begin collecting some new data that we could specifically target at pandemic issues. We put the first version of the survey into the field at the beginning of April 2020, and we've been developing and iterating on it since. So far, we've completed 8 waves of the survey, initially on a monthly schedule, then bi-monthly, and now quarterly. You can see the relevant dates here in the first bullet. Wave 9 is actually in the field as we speak. We'll likely have the results to begin publishing on that in about a month or so. So a couple of key points here about the survey. When you're looking at survey data and when you're using survey data, you have to be conscious of certain things about how the data is collected in order to understand how to interpret and how to speak about the data when it comes in. Our survey is 100% web-based. That gives us a lot of flexibility and speed to market advantages. It means we don't have to worry about training people who are doing calls. It means we don't have to worry about in-person interviews, things like that. We can update the survey instrument, we can get it distributed, and we can collect the information very quickly. However, we do have to be conscious of the fact that focusing on a purely web-based population means we're automatically focusing on a population that has access to the internet, has access to broadband, has technology that they can use to access it. Simply because we're doing a fully web-based instrument, we have to be careful about potentially extrapolating some of that information to the full US population. Another aspect of this is it's a cross-sectional survey. It's not a panel. Some panel surveys that you look at will actually track the same group of respondents over a period of time to see how their behaviors develop over time. We chose to do cross-sectional, which means we're looking at a different set of people who are roughly similar in terms of their demographics each time. Again, that allows us a little bit more flexibility, a little bit more speed to market, but it also means we are looking at a potentially slightly different population each time. With that in mind, one of the things that we've done through the course of the surveys is we've reweighted all of the data to be comparable with our first wave. What that basically means is that when I'm comparing wave 7 to wave 5 to wave 2 to wave 8, the data has been reweighted in order to be the same mix of people in terms of the age groups, the income groups, and the gender who responded to the original survey. That gives us the ability to be able to do a fairly reasonable comparison to how our population is developing over time, even though we're not looking at the same respondents in every single survey. What are we collecting? Obviously, the first set of things we're collecting, we've been doing this since the beginning, basic demographic information so that we can look at our data cut by a variety of different things. The key ones usually being age, income, race and ethnicity, gender. We have information about level of schooling. We have information about where they live, things like that as well. We've also been tracking employment information, both before the crisis and as of the time of the survey. Same thing with income, to try to get to the impact on respondents' incomes, their feelings about their financial security and their need for assistance, and then payment and banking tool usage. All of this has been pretty consistent through the course of all 8, now 9 waves in the survey. The only changes we've really made to these types of questions have been to account for the fact that the crisis has been going on a lot longer than any of us hoped or expected when we first launched this survey. Some of the questions were originally geared more towards a short-term look at what was going on with the consumers and the respondents. We've had to adjust the questions over time to account for the fact that we're asking people to look back now a year or more to tell us some of their information. Otherwise, we've been as consistent as possible with the information we've collected through these types of categories. The other thing that the survey has allowed us to do is very quickly adjust the questions to address specific issues and aspects of the pandemic experience. That's in the second set of bullets on this page. So we've been able to go in and get some insights into things like respondents' attitudes towards the relief packages, the impact that returning to school has had on people who have school-age children in their households. Most recently, we've been focusing on what we term as vaccine receptivity versus reluctance, which we'll cover a little bit later in the presentation. And then lastly, we have focused on doing what we refer to as our ad hoc subjects. So zeroing in on certain aspects of consumer finance, such as savings habits, the experience of education loan holders, the impact that people have found related to their health insurance during the crisis. And most recently in Wave 9, we're collecting some information on that revolving credit usage and overdraft experiences. This has allowed us, like I said, to focus in on specific aspects of consumer finance, and these sections are generating their own papers and research coming out of these waves as well. You can access all of that type of research at the Philly Fed's website, and I'll have the information on the web address for that later in the presentation. So now we'll get into the cool stuff. The following pages are a sample of some of the key findings from Wave 8 of the survey, which was conducted in April of 2021. The summary report itself was published yesterday, as Marty mentioned, and you could be able to find that on the Federal Reserve Bank of Philadelphia's website. So April 2021 was the 1-year anniversary of the survey launch. We did our first wave in the first 2 weeks of April in 2020. We did Wave 8, first 2 weeks of April in 2021. So one of the questions that we've asked since the beginning of the survey is how concerned respondents are about their ability to make ends meet over the next 3, 6, 9, and 12 months. So the chart here shows the percentage of respondents who selected the 2 highest levels of concern out of 5 levels. So 1 would mean that you are not concerned at all about your ability to make ends meet. 5 would mean you are significantly concerned. We took people who selected 4 and 5 from that response population. So understandably, what you can see here is that in April of 2020, we saw our highest levels of concern. That was a point in time where obviously no one really knew what was going to happen with the pandemic. Lots of things were shutting down, lots of jobs were being lost. There was a huge amount of concern. As you progress through the first few months of the summer, you see those concern levels dropping. They're still very high. 25+% of people being concerned about making ends meet over the next 3 months is still not a great number. However, it was clearly improving. Starting in September, however, which is the light blue line, you do see that concern begins to rise again. Same thing happens in November, the green line. My working theory at the time was that as we moved further away from the effects of the CARES Act, which was passed in the March-April timeframe of 2020, with no pandemic end in sight and no additional aid forthcoming, people were starting to express more financial concern. This continued through November. That theory that the CARES Act was potentially impacting the level of concern that people felt about their finances was supported in part, I think, by the January 2021 results. The federal government approved additional relief in late December, and it appeared that in the January wave, which is the dark blue line in these clusters, respondents were reacting positively to that. Levels of concern went down. Now, we expected that the approval of the significantly larger package in March would result in similar improvements in the April 2021 wave, which is the brown line on the right edge of each of these clusters. However, as you can see, that didn't manifest, much to my surprise. You can see in the last column of each of these groupings that overall concern actually increased in April. Why was that? Well, we started to dig into the underlying data, and we came across an interesting change in the trends for this field at the segment level. In this chart, I'm showing the change in concern levels between waves for respondents in different age groups. So basically, if concern in wave 1 was 30%, and in wave 2 it was 35%, that would be a plus 5% bar on this chart, and it would mean that concern was rising for that group. What we see here is that for the most part, all age groups moved in generally the same directions from wave to wave. So from wave 1 to wave 2, all age groups showed an improvement in concern levels. Conversely, between waves 5 and 6, all age groups showed increases in concern levels. The magnitude of the movements are different because people in different age groups were affected a little bit differently by different parts of the pandemic, but directionally, they're almost always consistent. Between wave 7 and 8, however, we see our first big divergence. Respondents in the two youngest groups are notably more concerned than they were in wave 7, while respondents in our two older groups are notably less concerned.
So actually, I'd like to pause on that very point. So
Absolutely.
why is there that disparity? And in fact, I would think it would be the opposite. If you're older, you might be more concerned about your financial future, especially if you're limited in your earning potential as you age. So can you explain why the concern is higher for younger people?
So I would love to be able to definitively say I can explain why it's different. I have my theories. One of the things that I have found in general in working with this survey data over time is that every time we ask a question that reveals something like this, it reveals 3 or 4 additional questions that I would have loved to have been able to go back and ask people who responded to this. One of the things that I think is occurring between wave 7 and 8, and if you keep in mind, that's between January and April of this year. The changes between January and April of this year went well beyond simply the additional relief package in March. You have the rollout of the vaccination programs. You have the more and more areas of the country announcing plans to reopen. You have kind of the beginnings of a light at the end of the tunnel. I think in some cases, what we're starting to see here is different segments of the population starting to think a little bit differently about what their situation looks like going forward beyond the pandemic itself. Up till January, most people were responding to the fact that while there were different impacts to different populations during the pandemic, everyone was still kind of hit in similar fashion. Now you've got different parts of the population getting access to the vaccines. You have different parts of the country opening at different rates. You have different levers pushing on people than simply the question of when will the virus no longer be a concern. As regards age, One of the things that we'll see a little bit going forward is that there are some differences in terms of how different industries are responding to the pandemic. There's differences a little bit in how certain populations feel about the vaccines, things like that. Some of those hotspots in terms of jobs coming back and wages coming back and income coming back will tend to be in populations that are younger. So it will be retail jobs, it will be restaurant jobs, things like that. Because those areas are still, I think, very much in question in terms of how well they're going to recover, how well the incomes are going to come back, how well the jobs are going to come back. I think you see more of a concentration in the age groups that are part of those industries about, well, it's great that the vaccine's out here, but I don't know if there's going to be jobs when I come back in. Now, that runs a little different, a little contrary to a lot of the press about how, there's tons of jobs that no one can find people to fill. But a lot of this is about perception, not necessarily about what's actually happening in the data. Conversely, at the older end of the spectrum, that's the population that as of April was getting faster and more complete access to the vaccines. They were feeling more confident, feeling more comfortable, and that likely influenced some of their feelings about their financial stability.
Thank you, Tom. And I'd like to just once again encourage anyone who has a question, please feel free to post it in the chat throughout the presentation. You don't have to wait until the end.
So the chart that we have on this page is similar to the last one, but now we're looking at different income ranges. And you see a similar phenomenon. In this case, between wave 7 and wave 8, the lower earning respondents, people who make less than $40,000 a year, are less concerned, while people that are making more money report that they are more concerned. And just as an explanation, that slot where you would normally see the orange bar for 40,000 to 75,000 incomes was basically level between wave 7 and wave 8. That's why it doesn't look like there's anything there. So in similar fashion to the question that Pia just asked about the age groups, what's a potential explanation for this? My theory here is that this is where we're seeing the most direct impact of the March relief programs. If you think about it, the key components of that March relief program that at least most people were focused on was the increased stimulus checks and the increased and extended supplemental unemployment benefits. Those two particular items, which were really kind of the flagship items that most people talked about in that program, are more likely going to help support people with lower incomes to begin with. It will help anyone who gets it, but someone making $30,000 a year is going to see a much more direct benefit to their day-to-day life than someone making $120,000 a year. So I think what's happening here is we're seeing people in lower income ranges who were justifiably more concerned than the average person about whether or not they were going to be able to pay their bills in the coming months, reacting to the fact that they now knew they had support for at least the short-term future, and saying that they were less concerned about making ends meet. Now, at the upper end of the spectrum, I think this is where we get into the issue of how the environment as a whole was changing. Going into April, as we started to see this light at the end of the tunnel, we were also starting to hear a lot of noise in the system about, well, are we going to go into an inflationary period? Is the economy going to be able to recover? Are we going to be able to get the jobs back? And I think in the higher income ranges where they're less needy of the direct assistance of the stimulus, we're beginning to see a little bit more concern about the situation as a whole and what we as an economy are going to look like coming out. We've debated a little bit about ways to kind of get to this information within the survey. We made a couple of tweaks in our Wave 9 to try to suss some of that out, and we'll see what we can get. But that's my working theory at the moment.
I'm going to pause for a second to take a question in the chat on this slide in particular. Any indication if we're seeing a large group retiring in that 50 to 55 and older group or 65 and older group?
So that is actually, oh, I could have planted that question myself, because we're going to talk a little bit in the next couple of slides about what we term as ability to work, and the type of employment that people report that they have. We do see within our response population that as of April, compared to prior to the pandemic, we have a higher percentage of people saying that they're retired. And those do tend to focus into those upper age ranges, and a little bit into kind of the middle income ranges. So I'll talk about it in a little bit more detail, but there does appear to have been a push of people moving into retirement during the course of the pandemic. The open question to a certain extent is that voluntary retirement or semi-voluntary retirement? Did someone's job go away and they basically decided, you know what, I'm not going to worry about going back and finding another job. I'm just going to go ahead and consider myself retired now, versus someone who may have been planning to retire during the course of the pandemic anyway, could have chosen to work if they wanted to, but went ahead and retired regardless. So we have seen an increase in retirements. Still an open question a little bit about kind of what the push towards that is. Would it have happened naturally, or is some of it forced? So speaking of employment and ability to work. So what we've thought of as ability to work is really, if you said that you were employed going into the pandemic, or that you were employed at the time that we were surveying you, we basically asked how you were currently doing your job. That basically includes tracking remote work versus on-site work, loss of job, and also loss of hours and schedule, among a couple of other things. So one of the trends that we've been seeing since the beginning of the survey is respondents are steadily returning to work on site and are steadily regaining their work hours and schedules. You see that in the two groups of columns on the outside of this chart. We're up about 65% of people saying that they're working on site, and just about 70% of people saying that they're working either normal or increased hours compared to pre-pandemic. The interesting section of this chart is the center section, where we asked people, are you currently laid off, furloughed, or no longer being paid? So these are people who consider themselves employed, but are laid off, not working, et cetera. You can see that at the start of the pandemic in April, when we had the most shutdowns and we had the most businesses kind of taking the really conservative approach and laying people off and things like that, we had a high point of close to 18% of our respondents telling us that they were in this status. That improved through the course of the pandemic, a little bit here, a little bit there, but steadily went down until about November. And since November, it's been level around 11% of our population. So that's a little bit troublesome, because it looks like the improvement has not continued. That is supported by a lot of the unemployment reporting in general. We did see a lot of jobs start to come back during the summer last year, and then things have been relatively steady, through the fourth quarter and the first quarter of 2021. But it is still a little concerning. You'd like to see that number moving a little bit differently. As with the financial concern numbers that we talked about previously, looking at the subsegments, you start to see a different story. So once again, we're looking now at people within the different income ranges across the 8 waves of the survey. And we start to see that people are experiencing very different outcomes right now, depending on what income range they fall into. So through November, if you look at the chart, you've got the blue line on the left of each cluster is April, down through the solid green line, which is November. You see that generally, with a couple of exceptions here and there, all of the income ranges gradually saw lower job loss rates as we moved to November. From November forward, however, we start to see different reactions. people making less than $40,000 have gone up pretty significantly in terms of their rate of job loss since November through to April. They're up to nearly 24.5% of that population saying that they've lost their job. The next band up, 40 to 75, has managed to remain level, but hasn't really improved. 75 and above, however, have both continued to regain jobs through the course of the last 6 months. This is sort of another example of kind of the importance of going in and trying to understand the underlying numbers. A lot of the numbers that we see in the press and a lot of the numbers that we see getting reported out are national numbers. And a lot of the nuance of what's actually going on within the population can get lost in those national numbers. It's one of the reasons why we've tried as much as possible through the course of the survey to focus in on the experience of some of these different segments.
So, and you may have answered this question in the previous slides, but as we saw in the previous slide, people with lower incomes were less concerned about financial security than people with higher incomes. But now we see in this case that lower earners were actually experiencing greater job losses than the highest earners. So then, and conversely, the highest earners were concerned about their financial security when their situation was actually improving. There seems to be a little bit of a contradiction here. Why is that?
That's an outstanding question. Again, unfortunately, I can offer my theories, but they're theories based on, honestly, a lot of intuition as opposed to some specific data coming out of the survey itself. I think within income in particular, when you look at the job loss trends versus financial concern, the lowest income segments, that story to me makes a fair amount of sense. Those populations are seeing their job losses get worse as opposed to even staying level, much less getting better. Therefore, their concern about making ends meet should be going up. However, at the same time that is happening, they are receiving a pretty significant amount of direct support from the government, which I think is offsetting that concern. The theory that is floating around significantly is that the things like the supplemental unemployment insurance are in some way preventing people from going and taking jobs. I'm not personally convinced that that is a significant factor in the job situation right now, but if you are struggling to find a job, and if you are struggling to find a job that pays you a living wage, then the fact that you received a large stimulus check and an increase in your supplemental unemployment insurance is going to make you feel a little bit better about taking a little longer to find the right job for you when you go back. Now, the fact that we have the higher income populations getting better from a job perspective, yet still feeling more financially concerned. I come back a little bit to my theory about how they're starting to get more worried about the economy as a whole and what that's going to do to them. There's not a huge amount that I can pull out of the survey data itself to support that, but that's my thought at this point.
I wanted to point to a question in the chat. Gabrielle, I'll come to yours at the end of that one, at the end of the presentation. This seems kind of all encompassing of what we've been talking about. But one specifically here is, what segments of low earners were losing their jobs in April 2021? Seems job openings were always looking for these workers. Were they just quitting?
So we have a little bit of data in Wave 8, which we go into a little bit more detail in the longer report that we put out yesterday. We did actually ask people who had job changes between the beginning of the pandemic and April of 2021, what the reason for their change was. And among the options that they could pick was that they voluntarily changed jobs, or whether they were laid off from their job, their business, the company they worked for shut down, things like that. We were still seeing a pretty high percentage of people, particularly in the lowest income ranges, who were losing their jobs involuntarily. Now, that particular question focuses more on why they went from being employed to unemployed, as opposed to why they are not necessarily picking up employment now. Unfortunately, at least within the context of our survey, we haven't quite had the space or capacity to dig that deeply into that question about what is preventing people, if anything is actively preventing them even from getting a new job. We have asked questions here and there about if you needed to begin working, or if you were going to begin working sometime in the next 30 to 60 days, what concerns would you have about doing that? That was in part to try to get early in the pandemic to issues about whether or not people were concerned about exposure to the virus, concerned about getting themselves sick versus loved ones sick, things like that. We have found that that concern about exposure to the virus has been going down, but what has been going up are things like concerns about finding childcare, concerns about access to public transportation, concerns about other things that are impacting people's ability to work other than just the jobs being available. So on this slide, actually, I'm going to talk a little bit about some of the unique data we started collecting in Wave 8. We decided to dig a little bit more into the types of employment that our respondents had prior to the crisis, and then what that looks like after 1 year. So that included asking people about the types of jobs that they have beyond just whether they're employed or not. So in the first box here on the left, you see about what you would expect. When you compare the end of 2019, before the pandemic started, to April 2021, we see that about 4.5% fewer of our respondents are employed. Drops from 70.7% down to 66.2%. If you look at the breakdown of those who aren't employed in the bottom part of that chart, you see that the biggest increase is under those who say that they're unemployed and looking for a job, which is up to 7% from 4.4% before the pandemic. That 7% is a little bit higher than the reported unemployment numbers, but is pretty close to the overall number. You see about the same percentage of people who say that they're not employed and they're not seeking employment. You also see a little bit of an increase to the question previously in the percentage of people who say they're retired. As I said earlier, some of those are probably people who would have retired anyway. Some of those are probably people who lost their job during the pandemic and now say, you know what, I'm retired, I'm not going to bother looking for a job. One of the things that I find interesting here, and it was a little different from what I would have expected, is that for those who are employed, the composition of their employment hasn't really changed. And that's in the right-hand box that you see called out. So there hasn't really been a big shift, for instance, towards people having to work part-time jobs or people adding gig work to a full-time job. There's been some theory, and you probably would have expected some movement in the types of jobs people were having to take in order to help them make ends meet. And that's not really manifesting itself, at least in the way that we asked this question in our respondent population. The other thing that's interesting, if you look at the percentage of people who selected more than one of these, because we allowed people to tell us things like, I have a full-time job and I'm a gig worker, that number didn't really change at all either. So some of that, I think, is a function of how much of these jobs, how many jobs were available, people's willingness to work, things like that. But up to this point, we haven't seen a lot of movement in this. So the next couple of slides come from a research brief we actually published a few weeks ago and is available on our website. Beginning in January, we started to ask people about their plans to get vaccinated. Now, the success of the vaccination programs is a key factor in the ability to reopen the economy smoothly. So tracking that has really been a focus within the Fed system in general since the rollout of the vaccines began. Encouragingly, when you look at January, where the vaccines were pretty much just becoming available on a relatively wide scale, there was still a lot of question about how that was going to happen and everything like that. between January and April, we see a big increase in what we're calling vaccine receptivity, which basically means people who report that they have already received the vaccine in at least one dose, or will get it as soon as it's made available to me. Now, keep in mind, we're talking about April here, which was before it had been opened up to the general population, where pretty much everyone could get it. So there were still portions of the population that could not get it, even if they wanted to. That's who we're picking up in that second category. That basically went from just over 50% in January to 70% in April, very encouraging. Now, reluctance on the right half of this chart did fall between January and April, but as you can see, there is still a decent chunk of people in April who say that they either do not plan to get the vaccine, have not decided, or preferred not to answer, which we're including as part of the reluctance population. As with the previous data, we'll look at a little bit of what we can see now within the subsegments. What we can see here is that there are definitely parts of the population who are significantly more reluctant about the vaccines. In particular, reluctance is higher among lower earning respondents, younger respondents, and then within the racial and ethnic segments, we see that non-white respondents are generally more reluctant. Now, encouragingly, we do see the largest improvement among Black respondents, who were above 45% in January, but they are still the most reluctant group within the racial ethnic categories that we have. The other thing that we found very interesting in the receptivity and reluctance is when we looked at it by industry. There's a pretty wide variance in the level of reluctance based on the respondent's industry. And what was interesting was that it seems to be those working in retail sales, leisure, hospitality, arts, and entertainment who are significantly more reluctant about the vaccines than those in any other industry. Now, obviously, this is kind of concerning because those are traditionally pretty high touch, high contact types of jobs, and they're reluctant about getting the vaccine.
And let's try to drill into that a little bit more, because you would think if you're at most risk, you'd be most willing to get the vaccine. So what's the explanation, or what is an explanation for why the people most at risk might be also the most reluctant?
Yep. So some of this is a demographic thing. So if you think about the types of jobs that tend to fall into the retail sales category, leisure, hospitality, arts, and entertainment tends to be things like both travel and hotel staffs, as well as restaurants, things like that. A lot of the workforce within that population is going to be a little bit younger. They're also going to be slightly lower earners. And if you look back at the previous slide, for whatever reason, lower earners and younger populations are showing more reluctant in and of themselves. I think that's translating a bit into the fact that these two industries in particular are showing high degrees of reluctance as well. It's simply because that's where a lot of, at least within our respondents, we tend to get younger and lower earning portions of the population. As to, kind of with some of the earlier questions, as to the issue of why and what can be done, it's hard to say. I'm with you. It would seem somewhat obvious to me that if I'm in a job or potentially have to take a job where I'm going to be interacting with people all day and standing in close contact with them and things like that, that you would be one of the first in line to get the vaccine. But there just seems to be a reluctance or resistance, whether it is not understanding how to get the vaccines, whether it's, and keep in mind, this is in April. So it's when things were first starting to be a little bit more broadly available to the population. So people in younger age groups weren't quite eligible to get the vaccine at this point either. There was still a perception at the time among large portions of the population that COVID was a bigger issue for older patients than younger patients. There was the sort of combined effects of all of those perceptions about the disease, I think, was kind of pushing it this direction. I'm going to be very interested to see in wave 9, which is going on right now, what these numbers look like. Because we'll now be in an environment where the entire population has been eligible to get the vaccine. A lot of the outreach on vaccines have shifted to focusing on how easy it is to get them and the fact that they are free. That's one thing that I've noticed, at least in our area, that a lot of the billboards and things like that have actually started to emphasize the fact that it's no cost to anyone to get the vaccine. I'll be interested to see if this environment for the last 3 months has moved these numbers at all. But as of April, I think that's what we were struggling against.
And you're in Pennsylvania, right? That's where you're seeing the building.
Yes. Yeah.
I just want one sort of related question is, I imagine that race is also overlapping in some of these industries as well, retail and hospitality. Is there a higher concentration of non-white workers in these industries?
Within our population, it is a little bit higher, but it's not actually a large shift into the minority populations within these categories. But it is impacting it a little bit, yeah.
And then there's a question in the chat. I'm hearing concerns from younger workers about fertility fears and fears about birth defects. Has this been approached?
So within the data in our survey, we have not gotten that specific about why people are reluctant. To be perfectly honest, we've discussed it a little bit, and we are concerned slightly that we're not 100% sure whether that would be productive to ask people in the context of this particular survey. We have to be a little bit conscious of how people will respond if we start digging into what a lot of people consider highly charged topics, so to speak. So we have debated a little bit whether to try to suss out the reasons that people are reluctant for vaccines, and have kind of chosen to stay away from that at this point.
Okay, please keep the questions coming. We're coming towards the end of our presentation, so feel free to keep posting in the chat.
So I will touch very briefly on one last piece of data, which is the effects of the relief programs. So it worked out reasonably well from a data perspective for us that wave 7 and wave 8 both took place within a few weeks of the federal government passing relief programs, the December smaller package and then the large package in March. So in both cases, we described the primary components of each program to the respondents, and we asked them then to select from the list that you see here to tell us how they thought, or if they thought, the programs would help them out. In both cases, we provided descriptions of those benefits. With the March question, we included the combined benefits of both programs together. We expected that with the passage of the larger program in March, we would see a result that told us that more people felt they were being helped. That sort of panned out. So what we're seeing here is that the tails of the population, the top part of the chart and the bottom part of the chart, didn't really change. You still have about the same percentage of people who said the programs aren't going to affect me. I'm financially stable. I don't really need any of it. About the same number of people said that they're not eligible for any of the programs, although the programs were generally available to the vast majority of people. So this might be a perception thing. And then at the bottom of the chart, you see that you have an identical number of people who say, I'm struggling so much that these programs will not make a difference, even for this next couple of months. About 5% of the population in both cases said that. And then about 8% of the population said they didn't even know whether the programs would help them. Where you see movement a little bit is in the middle. So about 5% fewer people reported that the programs would only temporarily help. Now, this might be a combination of the fact that there's a larger package, as well as a general improvement in people's situations between January and April, but it is a sign that there was some improvement nonetheless. Now, one of the debates that this opens is about the idea of the targeting and purpose of the relief programs. Who are they focused on assisting? In this particular case, it does appear that a portion of the population did benefit from the second larger relief program, but it didn't really make a noticeable change for the hardest hit population. So conscious of our time, I want to touch for a couple of minutes here on just the general data environment at the Fed. As I said earlier, we use a huge amount of data to fulfill our mandates, including things like monitoring economic indicators, forecasting them, analysis of policy impacts, and research on various macro and microeconomic topics. That data comes from a wide variety of sources as well. Some of these are ongoing relationships, and some of these are one-time purchases of information. It includes stuff from credit reporting agencies, stuff from payment processors that includes transaction level data, regulatory data collection from some of our sister agencies. We will periodically enter partnerships with industry participants and things like mortgage servicers to get data. All of this is completely anonymized. All of it is protected in any number of ways, from revealing any information at the consumer level. We also have a pretty significant history of survey use in the Federal Reserve System. We have a couple of the major consumer surveys listed here. The one in particular that I'll call out is the Survey of Household Economics and Decision Making, which is otherwise known as SHED. They actually released an update about two and a half or 3 weeks ago, I believe, on their most recent data. That one's always very interesting. We also do some surveys of professionals within economics, so the survey of professional forecasters, things like that. All of this contributes to an incredibly robust data environment within the Federal Reserve. As far as how my little project here fits into that, where do we go from here? We have one more wave scheduled after the one that's in the field right now. We're expecting it to take place probably at the beginning of October. And then from there, we'll take a look at what we've learned about the process, the benefits that we've received from it, and decide if there's a reasonable way for us to continue in a way that adds to the overall data environment here. Obviously, we don't want to duplicate effort. That would be a waste of everyone's time. But we'll start to try to figure out, are there ways that we can contribute to this environment and contribute to the types of analysis and decision making that we have to do that allows us to potentially move forward with something. So I'll end here with my contact information. I'll leave this up for a few minutes, and then these materials will be available after the presentation. I think we'll get them out later today. So you'll have my email address, the websites for CFI, as well as the Philly FRB's COVID-19 resource page, and then also the contact for our media person if you have questions about other work that the Philly Fed does. The other thing I'll note real quickly, since I know we have people from around the country, all of the 12 Federal Reserve banks in the system have very robust research departments and do a lot of work analyzing both national level issues as well as regional level issues for the portions of the country that they're responsible for. So if you are interested and curious about the types of work that is going on in your part of the country, I would highly encourage you to reach out to your local Federal Reserve Bank, go to their websites, and explore the kinds of things that are available. We are always happy to share the work that we do to whoever is interested in it. So thank you very much to everyone. So do we have any more questions, Pia?
Yeah, so one that I wanted to go back to, someone had asked, how do you keep all of these different trends straight in your head? How do you decide which ones come to the fore? Any advice, tips, tricks you have for us lay people trying to pull the indicator for our readers?
That's a really good question. In my case in particular, it's honestly because this has been 90% of my time for the last year or so. So I have looked at the data enough and been immersed in it enough that a lot of it is just sort of at the top of mind. In terms of layperson, looking at the information that is available out there, There's sort of two ways to think of it. In a lot of cases, you're relying heavily on people like myself to identify things that are important, and make the decisions based on our understanding of the situation as to what gets called out in the various reports and things like that. What I have found, and venues like this are sort of the perfect place for that a little bit, is that when I have been talking about these trends with other people, someone who is willing to ask questions about why will often make me think about slightly different ways to interpret the information. So when something doesn't quite make sense or doesn't quite feel right, posing the question to whoever is presenting that information serves to help them both reinterpret what they're doing in their heads as well, but also helps them understand, okay, maybe the message that I'm sending here isn't clear. So I need to rethink how I'm describing it. I need to rethink the way I'm presenting it, that type of thing. The other part of it as well is think about what you're seeing in the areas around you, what you're seeing with the people that you interact with, what you're seeing in local stories, in regional stories, and try to decide if what you're hearing about the trends and what you're seeing in the data that's being presented makes sense. If it doesn't, it could just mean that your area is different in some way or another. But it could also mean that there's something that needs to get pushed back on in terms of that piece of information. There's a huge amount of information out there and a huge amount of data out there. And it is challenging to figure out what is important and what isn't. There's a lot of stuff that we've collected in the survey that I would love to dig into and get out and publish, because I think it's fascinating information. And we just haven't had the time or the resource yet to do it. We will eventually have the baseline data for the surveys available publicly on our website. But again, that's a capacity and time issue that we just haven't quite gotten around to do that. But at some point, you would theoretically be able to go in, download the data off of this, from this survey off of our website, and crunch it yourself and see what else you can find, and see what other little nuggets of information are in there.
Well, we certainly appreciate all your efforts to try to get us as real-time information as possible. So thank you, Tom. I just had one last question in the chat for you. Do you use private third-party data in your studies or to check results?
We do. We have both for our general data usage. We will work with private companies to purchase data from them. That varies everywhere from general data like the credit bureau information I referred to working specifically with banks to get data on specific types of loans so that we can start to understand what's going on. As far as using that information to try to foot things like the survey results, we absolutely do that as well. I've been spending a lot of time working with my peers internally here to try to make sure that what we're putting out makes sense based on a lot of the other data that we have available. We certainly don't want to put something out that is going to be wildly different from what reality looks like.
So we are at time. I just want to thank Tom very much for speaking with us today, and thank you everyone for your really great questions. I'm going to turn it over to Marty.
Thanks again for being part of this great webinar today. Don't worry, I will tweet out and have Cebu tweet out when Wave 9 information is released, because I know a lot of you will be following this. I really want to thank our partners, the American Statistical Association, for their continued support of Cebu, the Organization for Business Journalists. On behalf of Tom, Pia, and everyone here at Cebu, thank you for attending today's webinar.
Thanks a lot, everyone.